Okay, sir. Let us continue, sir.
Okay, sir. Good morning to all. This is Dr. B. Prasad Babu, Assistant Regional Director, IGNOU Regional Center, Vijayawada. Our Delhi headquarters people assigned the nodal RC for conducting the PGDAB program to the Regional Center, Vijayawada. For last 4 days, we have conducted MAM 51, 52, 54, and 55. Conducted. Hemant Kumar has already taken 4 courses. Today we have MAM 53, Managerial Economics and Finance in Agribusiness. This course will be taken by Dr. GVSRNS Shastri Garu. He is Assistant Professor of Cabin College in our IGNOU Study Center 0103. So he is a senior most MBA faculty and Commerce faculty. He has 25 years teaching experience, and he will take this session, Managerial Economics and Finance in Agribusiness, from 11 to 1 o'clock. In between, if necessary, 5 to 10 minutes break will be there. Last 15 minutes, the students can ask their doubts, and sir will clarify your doubts. This is from our side. Sir, Shastri Garu.
Yes, sir. Yes, sir.
Let us start, sir.
Okay, okay, sir. Okay, sir. Okay, sir. Yes. Good morning to all. So, thank you, Prasad Babu Garu, for your attractive introduction. Yes, sir. So, we have 3 blocks in this course, that is Managerial Economics and Finance in Agribusiness. First one is Managerial Economics. First block is Managerial Economics. It consists of Introduction to Managerial Economics. Second one, Microeconomic Theory and Initial Applications. Third one is Market Equilibrium. Fourth one is Principles of Farm Management and Pricing Practices. And Unit 5, Equilibrium Condition. So in case of block 2, we have another 5 units, 6 units. That is Introduction to Accounting, Accounting Records and System, Preparation of Accounts. Next, Understanding Financial Statements. Next, Funds Flow Statement, Analysis of Financial Statements. So the third block is Agricultural Finance and Risk Management. So that is Sources of Agricultural Finance and Agricultural Risk and Insurance. So we have 13 units, consist of 3 blocks. So we will cover all the syllabus mostly. So first we can take the block 2, which is more interesting. Then we go for the first unit. So Introduction to Accounting. So in this, one must know what is accounting, what is the process of accounting, what are the concepts of accounting. Next, basic terminology of accounting and the needs of accounting. Next, what are the interested parties of accounting information? What is the difference between bookkeeping, accounting and accountancy? Next, various branches of accounting. Next, concepts and conventions of accounting. So first one is accounting means it is an art of recording, classifying, summarizing in a significant manner in terms of money, transactions and events which are in part at least of a financial character and interpret the results thereof. So first one, if you go for my explanation, so what we record, where we record, what we classify, where we classify, what we summarize, where we summarize. So these are the questions arised while observing this definition. So we can record, we can classify, we can summarize the transactions and events. So those transactions must be in terms of money, which means what is transaction? Transaction means transfer of money or money's worth. What is event? So while observing the events, one must have to know this following example. That is, a person started business for 20,000 rupees. He purchased goods for 5,000 rupees and he sold the goods for 8,000 and he paid expenses for 3,000. Ultimately, he get a profit of 5,000 rupees. By this example, selling the goods is a transaction, purchasing goods is a transaction, paying the expenses is a transaction. Next, the results, whatever the results earned by the uh, uh, organization is the event. So these type of transactions and events are recorded in journal. So recording is made in journal. Next to classification. Classification means so each and every transaction having two aspects or more than two aspects. One is debit aspect, another one is credit aspect. So if there is two or more aspects, so what will be debited and what will be credited, that is to be made in recording section, that is journal. So classification means grouping of accounts. Suppose we group the accounts, that is personal accounts are grouped. Suppose for example Rama, transactions pertaining to Rama is placed at one place. Like, provided if there is transactions relating to purchase of assets like furniture account is to be grouped. Next, if you pay wages, wages are grouped separate. So classification is made like that. So by classifying the transactions, one must know how much amount is spent for purchase of assets, how much amount earned by sale of assets, how much amount obtained from the creditors as loan, how much amount drew from creditors for want of giving credit. Next, how much amount spent on salaries, how much amount spent on rent, like that. So, after classification, we can summarize the results, which means by ledger balances, we can prepare trial balance. We can prepare trial balance. Trial balance is a statement which we prepared from the ledger balances. So, a trial balance is a statement which gives the arithmetical accuracy of the transactions made during the year. During the year. If two sides of the trial balance is equals, so we conclude that we record and classify the transactions as well. Sometimes both the transactions are equal, but there are some mistakes also. So that's why trial balance is used in like in that way. Next, ultimately we can prepare the final accounts by knowing the profit earned by the organization or loss suffered by the organization. So that is summarizing and simplifying. Next, this process, the recording process, the classification process, and summarizing process must be in significant manner, which means whatever the concepts and the conventions which we have in accounting, that is to be followed. That is to be followed. Next, all transactions must have financial character. No non-monetary transactions are recorded in accounts. So these results are to be interpreted. These results are to be interpreted by making financial statements analysis, by preparing funds flow statement, by preparing cash flow statement, like this. So this is the definition to the accounting. Next transactions are of two types. One is cash transaction and another one is credit transaction. Next, what is cash transaction? In a transaction where goods are transferred from one person to another person for want of cash, that is called cash transaction. If cash is transferred later, that is called credit transaction. In credit transactions, goods are transferred, cash will be paid after certain period. So how to recognize the transactions? So in case of cash transaction does not include any name. Cash transaction does not include any name. Sometimes cash transactions includes name of a person. In such a case, the word cash or the concept of cash must be included. So, identification of cash transaction is possible only when there is no name. And if name includes the word cash or the concept of cash must be included. Next, another one is credit transaction. Credit transaction must include name of a person. Must include name of a person. So, for recording purpose, transactions are divided into two types of accounts. One is personal accounts, another one is impersonal accounts. Impersonal accounts are subdivided into two categories, real accounts and nominal accounts. So, personal accounts means personal accounts relates to persons. So, person means an individual, HUF, firm, company, any artificial person. So, regard to accounting. So, these rules are on the basis of the types of accounts. Suppose in case of personal account, in case of personal account, debit means debit the receiver. Who receives the benefit is debited. Next, the credit the giver. Who gives the benefit is credited. So, this is the rule for personal account. Second one is related to assets, real account. Real account relates to assets. Assets are, what is asset? Assets are properties which belongs to the trader. Which belongs to the trader. These assets may be different kinds. One is fixed assets, current assets, and intangible assets. Fixed assets means assets which are acquired only for use, not for sale, not for sale. For example, if you purchase a fan for own use, that is called fixed asset. If you purchase the building for running the business, that is fixed asset. If you purchase a computer for business purpose, that is asset. Next one is current assets. Current assets are those assets which are easily converted into cash. Which are easily converted into cash. So the example for current assets are cash, goods, next goods, debtors. These are all current assets. As a goods, suppose for example, if you take an electrical shop, a fan purchased by the proprietor for their use on the top of the head, that is fixed asset. Next, the fans which are kept for sale is called goods. It's called goods. Then the item is one same. That is fan which is used by proprietor is called fixed asset. So fans which are kept for sale is called goods. So that is the distinction between fixed asset and the current asset. Next one is intangible asset. Intangible assets means assets which are not having physical existence. Which have not physical existence. We cannot see it, we cannot touch it. But we pay the amount. That is called goodwill, patent rights, copyrights, etc. Next one is for real account, the golden principle is Debit what comes in, credit what goes out. Asset which comes into the business is debited. Asset which goes from the business is credited. Next one is nominal account. Nominal account relates to yes, expenses and losses, incomes and gains. So expenses means expenses are incurred to run the business. Rent paid, salaries paid, commission paid, etc. Whereas in case of losses means bad debts. Debts which is irrecoverable is called bad debts. Next, again, nominal account pertaining to incomes and gains. Incomes are earned during the course of business. That is, commission received, dividend received. These are all called incomes. Next, gains. So, which we earlier said bad debts. Those bad debts are irrecoverable. Sometimes a person came to pay the amount, that is called bad debts recovered. That is called gain. That is called gain. Golden principle for nominal account is debit all expenses and losses, credit all incomes and gains. So these are the terminology and types of accounts which we use for recording the transaction. So next we go for objectives of accounting. The important objectives of accounting is one, to keep the systematic record. So by accounting, we record the transactions systematically. For what purpose it is recorded? To know the results of the business, results of the business operation. Results means we have only two results. One is profit and another one is loss. How much profit earned during the course of business? How much loss suffered during the course of business? That is to be ascertained. Next, that is possible for preparation of profit and loss account or income statement. Next one is to know the financial position of the business. Financial position of the business, that is to be ascertained by preparing of balance sheet. By preparing of balance sheet or positional statement. Balance sheet is prepared only from personal accounts and real accounts, whereas income statement is prepared by nominal accounts only. Nominal accounts only. And which means profit and loss account includes expenses and losses, incomes and gains. Whereas in case of balance sheet, personal accounts and real accounts are comes into the balance sheet. So balance sheet reflects the financial position of the. It is prepared on the basis of accounting principle. That is C plus L is equal to A. That is the accounting equation. C plus L is equal to A, which means capital plus liabilities is equal to asset. That is to be known by accounting. Next one is providing accounting information to the interested parties. So, by observing the definition of the accounting, so the last step is interpreting the results thereof. For what purpose we interpret the results? To give the information to the interested parties. Interested parties are different. One is internal source and external source. Internal parties, external parties. So internal parties are the owners. First one is owners. Owners came to know how much profit earned in the business. That is to be known by the owners. Next one is employees are known to the accounting information because if organization earns more profits, so the workers may get more hike in prices. So the creditors will know the accounting information because of recovery of their debts. So on the same way, tax authorities are very interested. If organization gets more profits, so the government also get more taxes. So like that, so these are the objectives of accounting. Next, need for accounting. So that is users of accounting information, that is also explained in earlier, that is creditors, owners. Owners means in case of sole proprietor is the owner. In case of partnership business, partners are the owners. In case of company, shareholders are the owners. So that is important. Next, investors, employees. So I already explained these things. Government, researchers, researchers. So researchers are also very interested about the accounting information for preparing various conclusions from their accounting information. For example, if you take an organization, say Vijaya Dairy, they prepare financial statements. So by getting the financial statements by researchers, they conclude they know the financial position of the business by preparing ratio analysis. They know the financial position by analyzing the financial statements. These are the things. So next, what is bookkeeping and accounting? Accounting involves a series of transactions, that is identifying, measuring, recording, classifying, summarizing, analyzing, interpreting, and communicating. So these are the things. But whereas in case of bookkeeping, that comes to the first four activities. Classification, up to classification, it is called bookkeeping. Next, branches of accounting. There are various branches of accounting, that is financial accounting, management accounting, and cost accounting. So we already explained about financial accounting. Second one is cost accounting. In the cost accounting, we ascertain the cost of a product made, we ascertain the cost of the services, which means transport service, kilometer passenger. In case of hospital service, patient bed, next. So these are all to be ascertained by mean in the cost accounting. Next, we can ascertain the cost in each process of processing a product. We can ascertain the cost in contract costing. So like that, there are different types of costings. That is single output costing, contract costing, next to operating costing and operational costing, next to process costing, like that. So in each and every type, we can ascertain the cost. Next one is management accounting. So management accounting means management means it is done through with others and taking decisions. Management means taking decisions. By getting the information from the financial accounting and cost accounting, they can rearrange the data for the decision making. Rearrange the data for decision making. So that is management accounting. Management accounting purely meant for managerial decisions. Suppose, for example, if we take the final accounts of an organization, that is profit and loss account and statement, the balance sheet, profit and loss account and balance sheet. The management has rearranged the profit and loss account and balance sheet by their convenience, by comparing with the other organization or by comparing with the within the organization, they conclude whether the financial position is good or bad, whether the long-term financial position is good or bad. That is to be done by done in the managerial management accounting. By preparing funds flow statement also, how much funds get in what way and how much funds applicable, these are to be ascertained by preparing funds flow statement also. So this is management accounting. There are certain concepts and conventions that are those are called principles of accounting. So These are the principles are called the language. The language accounting language more meaningful and commonly understood by all. It must be based on certain uniform, scientifically laid down standards. So these are the principles. The accounting concepts and conventions are principles of the accounting. First one is business entity concept. Business entity concept means business and the proprietor both are different in case of accounting. In case of accounting, in the eyes of law, proprietor and the business both are same in case of sole proprietor and partnership. Which means if the business assets are not sufficient to clear the business debts, that may affect to the private property in case of sole proprietor and partnership. So that what we said, the liability of sole proprietor is unlimited and the liability of the partner is unlimited. So which means that may affect the private property also. Whereas in case of company, so that is not occurs. That is not occurs. So while writing the while recording the transactions, so we conclude that business is separate from the proprietor. That is called business entity concept. So going concern concept. This concept means the business is running further. So that's why we can get the closing balances. Closing balances during this year will be the opening balances for the coming years. So that is next money measurement concept. So each and every transaction must be expressed by means of money. Other transactions which are other than money will not be enter into accounts, recorded into accounts. Why? Because, for example, if you purchase 10 liters of milk, if you purchase 10 meters of cloth, if you purchase 10 kgs of paddy. So these are all not possible to add it and record it in accounting. So these are all to be expressed by means of cash. These are all to be expressed by means of cash. 10 liters milk, 10 liters into 30 rupees, 10 into 30, 300 rupees. Next, 10 meters of cloth, 10 meters, each meter is 100, 10 into 100, 1000 rupees. Next, next is 10 kgs of paddy. Each kg paddy is 20 rupees. 10 into 20, 200 rupees. So by adding all these things, we can record the accounting books. So by means of kgs, by means of liters, by means of meters, we cannot record the accounting. So that's why each and every transaction must be measured by means of money. So that's why it is called money measurement concept. Next, cost concept. Cost concept means while recording the assets in the balance sheet, will show at the cost less depreciation. That is what we call cost concept. Next one is dual aspect concept. Each and every transaction having two items. One is debit aspect and another one is credit aspect. If you regard both the transactions, that is receiving aspect and giving aspect, that is called dual aspect concept. That will reflect the accounting principle, that is assets is equal to capital plus liability. Next, accounting period concept. So that's why accounting period means that is 1 year. In case of LIC, it is 2 years. So, which means the transactions pertaining to accounting period, which may consider January to 31st or April 1st to 31st March, whatever it may be. So, for during the 12 months, we can prepare we can record the transactions and we can prepare income statement and balance sheet also. Next, accrual concept. Accrual means what we consider the outstanding expenses, incomes receivable, incomes received in advance, expenses made, prepaid expenses. Prepaid expenses. That is what we call accrual concept, which means the expenses made during the year, whether it is paid or payable, income received during the year, whether it is received or receivable, that is to be considered while preparing income statement and balance sheet. That is called accrual concept. Next one is matching concept. Matching concept means each revenue is to be matched with the expenditure. That is called matching concept. Next, realizing concept. Next, like that, there are various concepts. Next, conservatism. These are the accounting conventions. Conventions means traditions. Traditions. For example, consistency. If you take consistency, we can maintain the consistency in policies and procedures. For example, if we charge the depreciation by means of fixed installment method, we have to maintain in all accounting periods like that. That is called consistency. That is consistency. At the same time, if you value the closing stock, that is cost price or market price, whichever is lower, whichever is lower. So these are all these are all called conventions. Conventions. Next, full disclosure. Full disclosure means everything is to be disclosed. Everything is to be disclosed. So that is called full disclosure. Next one is conservatism. Conservatism means there is no window dressing. There is no window dressing. There is no anticipatory profits. There is no anticipatory profits. అంటే కృత్రిమంగా సృష్టించినటువంటి no anticipatory profits and no anticipatory losses. So that is called conservatism. So these are all called the conventions. Next to accounting standards, there are nearly 29 accounting standards. 31 also, some of them are left from this from the accounting standards. I think number six, there is no accounting standard that was revised. AS 6 that is eliminated. So out of this, these are the list of the accounting standards. One must know it. Next, advantages of accounting. So whatever the objectives, that is, those are the advantages of the actually speaking accounting. Other than that, so these are the advantages of accounting. One is replace memory. Since all the financial events are recorded in books, there is no need to rely on memory. Which means whenever we record the transaction, we need not keep the information in memory. So the books of accounts will serve as historical record. Next one is meet the information requires. Other than that, various interested parties such as owners, lenders, creditors, etc., are get necessary information at frequent intervals, which helps them in their decision making. Next, it assists the management in many ways. So this is also explained. Facilitates a comparative study. So this accounting information is useful for comparing, useful for comparative study. So we can prepare comparative, comparative income statement, comparative balance sheet, common size income statement, common size balance sheet, for managerial decisions. Next, act as reliable evidence. So, accounting information is reliable if there is any court case occurs. Court case occurs. Next, tax matters. Tax matters. Tax are not tax. It is tax matters. Tax matters. So, in case of customs duty, excise duty, sales tax, income tax, for the purpose of tax, the accounting information is very useful. Next, ascertain the value of business. For ascertaining the organization, that may be sole proprietor or that may be firm business, and all these should be ascertained by accounting information. Next one is limitations of accounting. Next, limitations of accounting. First limitation is accounting is record only financial transactions having financial character. So, transactions which does not have financial character cannot be recorded in accounting. Next, the data is used only historical nature. So, there is no future estimation. There is no future estimation. Suppose, for example, if land and buildings are there, if they are more value, what it stated in the balance sheet. Balance sheet, if you show balance sheet as 10 lakh rupees, but the market value is more. So these are said the data in accounting is in historical nature. Facts recorded in financial statements are directly influenced the accounting conventions and personal judgments. Next. Data provided in financial statement is insufficient for proper analysis and decision making. So whatever we giving by accounting information, sometimes it may suitable, it may not suitable for decision making. So the information which provides, which we get by the financial accounting is not sufficient to make the decisions. So these are the limitations of the accounting. So the one must have to study the essence of this block, and another one is we can know the keywords of the topic. This is very useful for examination for purpose. This is to be recapitulate. Recap. This is for recap. Next, unit and the questions. So these are also very important. Next, accounting records and systems. So in this, one must have to learn journal, classification of accounts and their rules, systems of accounting, types of transaction, casting and carry forward, cash book, trial balance. So these are all I have already explained. These are all I explained in the earlier chapter. Journal means it is called books of personal entry. Book of personal entry. Journal is came from the Latin word jure. Jure means it is a daily record. It is a daily record. Transactions which we conducted in the business is recorded in chronological order. Chronological order means day to day. Day to day. So it is to be prepared by the principle of double entry system. Double entry system. So what is double entry system? Double entry system means each transaction having two effects, that is debit aspect and credit aspect, or receiving aspect or giving aspect. So if both of the aspects are recorded, that is called double entry system. Double entry system. So the slogan for double entry system is every debit having corresponding credit and every credit having corresponding debit. So this system is introduced by a great mathematician, Luca Pacioli. Luca Pacioli. That's why he is called father of accounting. That's why he is called father of accounting. Next one is, so in journal, it consists of 5 columns. One is the date, particulars, ledger folio number, debit amount, credit amount, like that. So by knowing the record of journal, one must have to know the one must have to observe the transaction first. Whether the given transaction is cash transaction or credit transaction. So one must have to identify the transaction. So first you have to identify the transaction. The given transaction is cash or credit. So how to identify the cash transaction? So in cash transactions, there is no name of a person. Sometimes cash transactions include name of the person. In such a case, the word cash or the concept of cash must be included. Included. So that's why first you have to identify the transaction. Next, pick up the two aspects. Pick up the two aspects. If given transaction is cash, give preference to cash first. So first aspect will be cash. Then the other aspect will be different. Next, if it is credit transaction, give preference to name first. Then the other item will be selected according to the transaction. If then third step is apply the rules. Apply the rules. What are the golden rules for various accounting? In case of personal account, debit the receiver, credit the giver. In case of real account, debit what comes in, credit what goes out. Whereas in case of nominal account, debit all expenses and losses, credit all incomes and gains. So these are the rules which you have to apply. First, you have to write the debit aspect, followed by the credit aspect. So that is very, very important. So that is to be learned by a person with physical touch. When we would person having physical touch. So what are the systems of accounting? Systems of accounting is double entry system. So it is wrong actually. Systems of bookkeeping is double entry system, single entry system. Systems of accounting is two types. That is uh, that is uh, uh, that is accrued system, next hybrid system, next cash system. That is systems of accounting. Systems of accounting. The systems of bookkeeping is these two. That is double entry system and single entry system. What is double entry system? So I already explained. The transactions are divided into three categories. That is personal account, real account, and nominal accounts. We consider all the accounts for writing the transaction, for recording the transactions. So under double entry system, each debit having a corresponding credit. So each credit having a corresponding debit also. Next one is single entry system. It is called incomplete record. It is also known as incomplete record. We consider only personal transactions under this personal accounts under single entry system. Sometimes we may consider cash transactions also. So that's why by using single entry system, we cannot prepare financial statements, that is profit and loss account and balance sheet. So that's why it is called incomplete record. The next one is, so these are the differences between double entry system and single entry system. It is very, very important question. Next one is types of accounts and golden rules is also important for that. Next, so there is example for problem. So we can see started business with a capital of 4 lakh rupees. Who started? X started a business with a capital of 4 lakhs. So here there is no name of person. No name of person. So it is called cash transaction. One is cash, another one is capital. So according to business entity concept, business is differ from proprietor. So in organization side, whenever a proprietor introduces capital, so capital comes into the business. Capital comes into the business. So by means of cash, so we received cash from the proprietor. So cash comes in. So this is cash transaction. One aspect is cash, another one is capital. So here cash comes in. So debit what comes in as per the real account rule, cash comes into the business. So cash is debited and another one is capital is to be credited. That is the answer to it. C, cash account data to capital account. Next one is sold goods for cash. So here also there is no name. So that's why it is cash transaction. One is cash, another one is sales. So here also it is cash. Cash is real account. So real account rule is debit what comes in, credit what goes out. Here when we sold goods, cash comes in, goods goes out. So cash comes in, debit what comes in, cash is debited, goods are credited. So write cash account data to sales account, Goods are classified into four ways. One is if you purchase goods, write purchases instead of goods. If you sold goods, write sales instead of goods. If you received returns, so goods comes in, write sales returns instead of goods. If we return the goods to the customer, the creditors, write purchase returns instead of goods. That is to be considered. Next one is purchased goods from Ram and Sons. Purchased goods from Ram and Sons. So here there is a name. So that's why it is called credit transaction. That's why it is called credit transaction. So give importance to Ram and Sons first. Ram and Sons is personal account. Personal account rule is debit the receiver, credit the giver. So here Ram and Sons is receiver or giver. Purchased goods from Ram and Company. We purchased goods, which means Ram and Sons gives the goods. So credit the giver. Ram and Sons is to be credited. Purchases are to be debited. So the answer is purchases account data to Ram and Sons account. Next one is next sold goods to Shyam Brothers. So here also name is given. So that's why it is called credit transaction. One is Shyam and Brothers, another one is sales. Whenever we sold goods to Shyam Brothers received the goods. So Shyam Brothers are receiver here. So debit the receiver. Shyam Brothers are debited, sales are credited. So the answer is Shyam Brothers account data to sales account. So like that, we have to first you have to identify the transaction. If given transaction is cash, give importance to cash first. Then apply the real account rule, whether it is debited or credited. So if the first aspect is debited, the other aspect is automatically credited. If first aspect is credited, the other aspect is automatically debited. So that is to be done in like that. So here it is require narration, being cash sale of goods. So this is called narration. Narration means shortened form of the transaction. Without narration, there is no value to the general entry. So for each and every transaction, one must have to write the narration. So here in this book, only for some transactions, narration is written. For example, so we need to write the other transactions. So for writing the narration, simply we kept being to the given transaction. Being started business with a capital, being sold goods for cash, being purchased goods from Ram and Sons, being sold goods to Shyam and Brothers, being bought goods for cash, being purchased furniture, like that. Next. Next one is ledger. Ledger means classification of transactions. Ledger means classification of transactions and a grouping of transactions. Ledger consists of 4 columns either side. Ledger is a summarized record in the form of capital T. Summarized, it is a summarized record in the form of capital T. The left side is known as debit side. So we divide it into two parts. This is called left side. This is called right side. Left side is known as debit side. Right side is known as credit side. So left side we have 4 columns: date, particulars, folio number, amount. The right side also consists of 4 columns: date, particulars, folio number, amount. So each the ledger having 4 columns either side. So in debit side there are 4 columns. In credit side there are 4 columns. Next, suppose if you take how to post the journal into ledger. Suppose if you take the first example, cash account debtor to capital account. So for each and every transaction we have 2 aspects. Next are more aspects also. Sometimes we have 3 also. So it requires to prepare accounts for all aspects. All aspects. While preparing accounts for all aspects, one must have to know. Account which we prepared need not be repeat. Which we open once opens, it need not be repeat. It need not be repeat. So the account which we opened is not included in that account. The other aspect will be recorded. For example, if we prepare a cash account, in cash account, the other aspect will be recorded. So 2 represents debit, 2 represents debit. So if you prepare a cash account, so put heading for ledger cash account. Ledger means, so here you write cash account, name of the account cash account. The other aspect will be recorded. So what is the other aspect? 2 capital. 2 represents debit. So that's why 2 capital is recorded in debit side of cash account. Debit side of cash account. So next you have to prepare capital account. If you prepare capital account on the top of the account, next the other aspect is debit cash. That was debited in journal. So whatever the account debited in journal will be recorded in credit. Whatever the account credited in journal is to be recorded in debit side. So that is just reverse to journal. So first one is account which we prepared need not be repeat. So the name of account is not to be occurred in the same account. One is if any account is debited, that should be credited in ledger. Whatever the account credited is debited in ledger. So after posting all the transactions, one must have to balance it. One must have to balance it. That is what we call ledger balances. That is what we call ledger balances. For example, if you take one account that is say Pankaj Brothers account. Pankaj Brothers account. So here we have 2 transactions. One is debit transaction and another one is credit transaction. First, you have to how to balance the account. So in such a case, here also we have 2 or 3 steps. One is one must have to add the heavier side. So that may be debit or credit. So in this particular account, so debit is higher. So here debit side 20,000. In case of credit side, there are 2,000. So here in debit side is higher. So that's why you have to add debit side. Put the same amount in opposite side. Put 20,000 in opposite side also. Ascertain the difference. Ascertain the difference. Difference means debit minus credit or credit minus debit. Difference means heavier amount minus lower amount. So 20,000 minus 2,000, that is 18,000 difference. So that difference is to be recorded in lesser side within the account. Lesser side within the account. So here it is lesser. So we have to write in within the account. That is what we call balance carried down. Balance carried down. If it is credit side, write by balance carried down. If it is debit side, write to balance carried down. So the same balance will be brought down to the next. That is called to balance brought down. Next year, that is what we call to balance brought down. If it is prepared for monthly, if that is to be made, by monthly. So this is March 31st. April 1st, we can brought down the balance. So that is to be done. So this is balancing of account. Next to cash book. Next to cash book. So this journal and ledger is to be done in case of sole proprietor or where the transactions are lesser. Suppose in case of big business units like companies, etc., etc. So we have to prepare subsidiary books instead of journal. Subsidiary books instead of journals. So the all transactions are divided into 8 subsidiary books. One is purchase book, sales book, sales returns book, purchase returns book, cash book, bills receivable book, bills payable book, journal proper, like that. So out of which we have another one is cash book. Out of these 8 subsidiary books, cash book, cash transactions are recorded in the cash book. The other credit transaction will be recorded in other 7 subsidiary books. So here in your syllabus, cash book is highlighted. So cash book means under cash book, we record the transactions, only cash transactions. So cash book is a real account. So that is prepared by real account principle. Debit the receiver, debit what comes in, credit what goes out. All cash receipts are debited and all cash payments are credited. All cash receipts are debited and all cash payments are credited. So these cash book may be different types. That is simple cash book, double column cash book, triple column cash book. So if a simple column cash book means we have only amount column, one amount column. Suppose if it is a double column cash book, so here we record discount and amount column. If it is the triple column cash book, so cash and bank account is maintained itself. So that's why cash column, next to discount column and bank column also appears. So cash book which contains 3 columns, 3 amount columns, that is called triple column cash book. Cash book which contains 2 amount columns, that is discount and cash, that is called double account, the double column cash book. Cash book which contains only cash amount, that is called simple cash book. So here we have example for simple cash book. So let us observe it. Bought goods for cash. Whenever we purchase goods, cash goes out. That is payment. So write by purchases 5,000 rupees. Next one is sold goods for cash. Whenever we sold goods, cash comes in. So that is receipt. Write sales debit side. 2 sales, 4,000 rupees. Next here, another one is also there. Commenced business with cash. Whenever proprietor introduces the cash into business, cash comes in. That is cash receipt. That is to be debited. That is to be debited. So 2 capital, right? 2 capital in debit side. So like that, if it is receipts, that is to be debited. If it is payments, that is to be credited. So cash transactions includes only cash transactions, not credit transactions. So for example, goods purchased from Anil on credit, this transaction will not appear in cash. Paid to Anil, so this is payment by Anil. Cash sales, which means receipts, 2 sales. Purchased furniture for office. Whenever we purchase furniture, cash goes out. It is payment by purchases. Paid wages. When we paid wages, cash goes out by wages. Paid rent. Whenever we paid rent, cash goes out. So by rent. Received commission. Whenever we received commission by means of cash, cash comes into the business. So right debit side. Withdraw for personal expenses. So that is, there is a technical word which we use in accounts is called drawings. Drawings means any amount of cash or goods which is used by a proprietor is called drawings. Paid salaries. So whenever we pay salary, cash goes out, that is payment, that is to be credited. So after making all the receipts and payments, it is necessary to balance it. Balance it. Next, trial balance. Trial balance means it is prepared from ledger balances. If we know the arithmetical accuracy of the books maintained by preparing trial balance. So, debit balances are recorded in debit side, credit balances are recorded in credit side. Then these two sides must be equal. These two sides must be equal. If two sides are equal, we conclude that the books and the journal and ledger is properly maintained. So, by this, we know there are certain, by preparing trial balance, one must have to know the debit balance and the credit balance. Opening stock debited, assets are debited, sales returns are debited, purchases are debited, next assets are debited, next expenses are debited, losses are debited. Whereas sales credited, purchase returns credited, incomes and gains are credited, liabilities are credited in trial balance. That is to be known by the student. Next. That is also over. Next one is, so let us practice all these exercises which are given in the problem. Preparation of accounts. Next one is, here we have to consider capital and revenue. Capital and revenue. So what is capital and what is revenue? So these capital and revenue may be capital expenditure or capital receipt, revenue expenditure or revenue receipt. Capital means, suppose for example, capital expenditure means, the capital expenditure means it is huge payment, huge payment. It is to be paid once in certain period, not every month or not every day. Next, it is generated income. It is generated income. That is called capital expenditure. So whereas revenue expenditure is, it is occurs a number of times in a year or a month, and it is small in nature, and it is for running the business. It is for running the business. For example, capital expenditure means acquiring the assets, purchase of assets, next installation charges of assets, next extension to the assets, advances to the assets. These are all capital expenditure. Revenue expenditure means payment of various expenses like salaries, wages, commission, etc. So these are called capital and capital expenditure and revenue expenditure. The same is also applicable to incomes also. Capital receipt means whenever we received a lump sum amount from any person or public, that is called capital receipt. Revenue receipt means if we received income number of times in a year, it is called revenue receipt. Next, next one is final accounts. Next one is final accounts. So here manufacturing account is also given. So final accounts are different types. If final accounts prepared by the manufacturing unit, so the manufacturing final accounts consists of manufacturing account, trading account, profit and loss account, and balance sheet. But whereas in case of trading concerns, which means there is no manufacturing. So these organizations has to maintain trading account, profit and loss account, and balance sheet. So why trading account is prepared? Trading account is prepared to ascertain gross profit or gross loss. Gross profit or gross loss. What is gross profit and what is gross loss? Sales minus cost of goods sold is called gross profit. So, what is cost of goods sold? Cost of goods sold means opening stock plus purchases plus all factory expenses minus closing stock is called is called cost of goods sold. If we deduct this from sales, if it is the result is positive, that is called gross profit. If it is negative, that is called gross loss. Gross loss. So this gross profit and gross loss is to be brought forward to profit and loss account. Next, we prepare profit and loss account. Under profit and loss account, we consider office expenses, administrative expenses, selling expenses, distribution expenses, research and development expenses, financial expenses, etc. So, by preparing final accounts, we prepare net profit or net loss, net profit or net loss. So, after that, we prepare balance sheet. So balance sheet is prepared under two ways. One is from current assets to fixed assets, current liabilities to fixed liabilities. Another one is fixed liabilities to current liabilities. Next, fixed assets to current assets. This is what we called marshalling of assets. Marshalling of assets. Marshalling of assets. Order of preference and order of permanence. Order of preference and order of permanence. That is called preparation of balance sheet. Under balance sheet, we have to know the record the real accounts and personal accounts. Real accounts and personal. While preparing final accounts, one must have to consider all the adjustments. Adjustment means it is a transaction which we have to consider while preparing final accounts. So they have also twofold effect. They have also twofold effect. So the adjustments which are given is appears once in trading and profit and loss account. Secondly, it comes in balance sheet. 99% it will occur. Sometimes some transactions, maybe 1% transactions may appear two times in trading and profit and loss account itself. So, suppose for example, these are outstanding expenses, closing stock, prepaid expenses, incomes receivable, incomes received in advance, income received in advance. Next, incomes received in advance. Next, depreciation on assets, depreciation on assets. Next, bad debts given in adjustments, provision for bad debts given in adjustments. Next, there are the discount provision on debtors, discount provision on creditors. Next, so these are all to be considered in final accounts. So this is a practical lesson which you have to do in the let us go through the syllabus. Let us go through the syllabus. Next one is so we can take the little break, 5 minutes break, then we come back.
Okay, sir.
Okay. Yes, good afternoon. Hello.
Good afternoon, sir.
Yes. Next, depreciation. 8.8. Depreciation means any decrease in the value of an asset by using or not. That is called depreciation. So depreciation occurs under this following causes. One is wear and tear, used. That is, the depreciation will occur. Next one is passage of time. If you are not using the asset and kept idle, then the value is also decreases. Or if you are undertook a asset for a period of 5 years, 10 years, like that. If time is passes, so the depreciation will occur. Exhausting, it is occurs by means of in the minerals. Minerals means oil wells, next to quarries, like that. If you extract the things, so the value of the value is also decreases. The next one is if any changes occurs in the mode, so the depreciation will occur. For example, new innovations. Suppose if a motorbike gives 60 kilometers per liter. If new innovation is invented, if the motor vehicle comes 100 kilometers per liter, so the earlier motorbike loses their value. That means that is also depreciation. So objectives of providing depreciation is replacement of asset, determining of true profit or loss, presentation of assets in the balance sheet, next to determination of correct cost of production. So these are the things. Next to factors affecting the amount of depreciation. First is asset value, next is estimated life period, next to scrap value. Scrap value means value of the asset after completion of the estimated useful life period. So these are all factors affecting the depreciation. Next, methods of depreciation. We have so many methods. That is, one is a straight line method. This is also known as fixed installment method. This is also known as marginal cost method. Under this method, we charge depreciation on marginal cost of the asset. Marginal cost of the asset. If it runs full year, it is to be charged full year. If it is runs certain months, we can charge it in certain months. Next one is declining balance method. This is also known as diminishing balance method or written down value method. Under this method, the depreciation is called calculated on balance brought down of the every year. Balance brought down of the every year, which means asset value minus depreciation. For example, the difference for these two is a purchased asset for 1 lakh rupees, depreciation is 10%. Under straight line method, the depreciation in entire life period of the asset is 10,000 rupees. Whereas in case of diminishing balance method, first year is 10,000, second year is we can get the balance 90,000. So the depreciation is 9,000. In third year, we can get the balance of 81,000. So the depreciation is 8,100, like that. So that is called diminishing balance method. There are several other different methods. That is annuity method, depreciation fund method, next to depreciation fund method, next to insurance method, mission hours method. So there are different methods. Next, these are the accounting for price level changes. It is new concept. That is the current purchasing price. So this is not important for this unit. Next, next one is understanding financial statements. Financial statements are trading profit and loss account and balance sheet. So it is prepared in vertical form or horizontal form. So this is the vertical form of profit and loss account. Sales less returns, net sales less cost of goods sold. Cost of goods sold means opening stock plus purchases plus factory expenses minus closing stock. Then we get the gross profit. Next, less operating expenses. Operating expenses means office and administrative, selling and distribution expenses. Next, then we get the operating profit. Then the operating profit is added by non-operating incomes. Non-operating incomes means other than business incomes. In dividends on shares, income from investments, profit on sale of assets like that. So this is to be deducted by non-operating expenses. Non-operating expenses means which are not pertaining to business. So that is interest, loss on sale of assets, etc. So then we get the profit before tax. So then we pay tax, then the results will profit after tax. Like that, balance sheet is also prepared in such a way that is current assets next to less current liabilities. By observing these two, we know the working capital position. We know the working capital position. Next, fixed assets are compared with the fixed liabilities. Fixed liabilities means capital, capital and long-term loans. Long-term loans. So these are the vertical form of balance sheet. Concept of profit, this is already explained. Appreciation of profits, capital surplus, shareholders funds. Next. Funds flow statement. So what is fund? Fund means capital fund. Capital fund means assets minus liabilities is called capital. Next one is cash fund. How much cash holds by the organization is called cash fund. So here funds flow statement means here it is working capital fund. Working capital fund means current assets minus current liabilities. So how to prepare funds flow statement? So there are various steps in preparation of funds flow statement. One is schedule of changes in working capital. Schedule of changes in working capital. Working capital means current assets and current liabilities. Current assets are increased. So working capital is also increased. If current assets are decreased, working capital is also decreased. So in case of liabilities, if current liabilities are increased, working capital is decreased. If current liabilities are increased, working capital is also decreased. So in case of assets, working capital flows in same direction, whereas in case of current liabilities, working capital flows in different direction. Next, prepare all non-current assets and non-current liabilities accounts. Second step is non-current liabilities accounts and non-current assets account is to be prepared by considering opening and closing balances. Opening and closing balances. Assets shows debit balance. So opening balance is debited, closing balance is credited. Whereas in case of liabilities, liabilities shows credit balance. So opening capital is created in credit side, closing balance is debited. Next, third step is consider all the adjustments. Consider all the adjustments which are given in the problem under double entry system. Which means this will come in particular account and it also comes in profit and loss account also. So the balance in profit and loss account is called funds from operations. Funds from operations. Funds from operations. Next, that is next. Prepare funds flow statement. So all funds inflow is debited in left side. All funds outflow is recorded in credit side. Recorded in right side. Here, see here, sources are in left side, applications are in credits, in right side. Sources means issue of shares, obtaining loans, issue of preference shares, sale of fixed assets. These are all sources of funds. Application of funds means purchase of assets, purchase of investments, then next to repayment of preference shares, repayment of debentures. So these are all called application of funds. So these are the problems which are given in the problem. Next. Next one is analysis of financial statements. So financial statements are analyzed under comparative analysis, common size analysis, cash flow analysis, funds flow analysis, ratio analysis, like that. So in case of comparative financial statements, so the name itself reflects the concept. Comparative. Comparison is made for two companies or comparison made for 2 years. So by making comparison, whether it is increased or decreased, whether the item is increased or decreased to be considered in first stage. Next one is percentage of increase or decrease is to be accepted. So see, suppose if it is compared to income statement, first one must have to know. Oh my God. So here there is no problem. Third, when financial statement figures are more than 2 years are placed side by side, facilitating comparison, these are all called comparative financial statements. Common size statements means statements which are converted into common size. Suppose, for example, if we take profit and loss account, the entire data is converted into sales, which means sales are taken as 100 and the others are to be calculated on sales. Suppose if it is if we prepared balance sheet, comparative balance sheet, take total balance sheet total as 100. So the other items are proportionate to that. Next, funds flow statement, I already explained in the earlier chapter. Next one is cash flow statement. Cash flow statement. Cash flow statement. So while checking cash flow statement, we have to go for ratio analysis. Ratio means relation between two. Relation between two. So this ratio may be expressed by means of percentage, by means of proportion, by means of fraction. For example, A and B sharing profits and losses in the ratio of 3 is to 2. 3 is to 2 means that is proportion. Suppose if you want to convert it into percentage, in fraction, 3 by 5, 2 by 5. 2 by 3 by 5, 2 by 5. Out of 5 portions, A get 3 portions. Out of 5 portions, B get 2 portions. If it is expressed by means of percentage, 3 by 5 into 100. So we have to multiply 100 for getting percentage. 3 by 5 into 100, 2 by 5 into 100. So the result is 60%, 40%. 60% and 40%. So ratio means like that. Ratio may be in percentage, ratio may be in fraction, ratio may be in proportional. Next, these ratios are classified into different types. One is profit and loss account ratios, balance sheet ratios, and both profit and loss account and balance sheet ratios. So they have fixed formulas. According to formula, we can calculate the ratios. We can calculate the ratios. Next one is, so the second unit is over. Next we go for third plan. Sources of agricultural finance. Next, agricultural risk and insurance. Here, sources of finance. Sources of long-term finance, short-term sources of finance. Types of capital, types of finance. So, capital means that there are different types of capital. One is fixed capital and another one is working capital. So, first working capital means capital which requires for day-to-day transactions is called working capital. So, capital which we paid for acquiring raw materials, paid for payment of wages, paid for expenses is called working capital. Fixed capital means capital which requires for acquiring fixed assets. Fixed assets means land and buildings, plant and machinery, agricultural equipment, furniture, etc. These are all come under types of capital. So this is the circle of working capital. Cash is converted into goods. Goods be converted into debtors. Debtors may be in bills receivable. Bills receivable will be converted into cash. Next, types of finance. Finance may be of long-term finance and short-term finance. Long-term finance means medium term also there. Medium term also there. So, if a short term means the finance is provided for 3 months to 2 years, that is called short term finance. Short term finance is mostly used for working capital, whereas long term finance means it is more than 2 years, 2 years to 10 years period. So it is we have to get long term finance for fixed capital. Next, so this is short term capital, cash, inventory, work in progress, finished goods, debtors, goods receivable, like that. This is the operating cycle in the manufacturing firm, selling of goods or credit. Sources of finance. Finance are of two types. One is owned capital and another one is borrowed capital. Owned capital means it is the capital which we arranged by ourselves, which is by issuing of shares. Suppose in case of sole proprietor, by getting hand loans from the friends and relatives. Suppose in case of companies, we can issue the shares. That is called owned capital. Issue of shares, issue of debentures. By getting capital, by issue of debentures is called debt capital. That is borrowed capital. Next, sources of long-term finance is owned capital, retained earnings. Retained earnings means undistributed profits. Generally, profits which we earned during the year is to be distributed to the shareholders as dividends. By coming risks, some organizations having right to retain some profits for future risks. So that's why they are called retained earnings. Next, funds borrowed from friends and relatives, loans from commercial banks, loans from national level financial institutions, loans from various state level financial institutions. So these are all explained in here. So for the purpose of agricultural agri-business, there are separate institutions to provide capital. Capital provide చేయడానికి వేరే institutions ఉన్నాయి. So there are short-term finance also. There is bank overdraft, cash credits, discounting bills, short-term loans, that is 3 months to 2 years. 2 years. Trade credits means credit given for a period, that is 3 years, 4 years, 5 years, like that. Next, accounting, accounts payable, advances from customers. Suppose if you conduct a business, we can get the advance from the customers. Accruals, factoring, cooperative credit societies, others, indigenous bankers. Bankers means irregular bankers. So these are all the sources of finance. Next, specialized financial institutions. So we have two types of specialized financial institutions which provide finance. That is, national level financial institutions are, say, IDBI, Industrial Development Bank of India. Next to IFCI, next to SIDBI, Small Industries Development Bank of India, Regional Rural Banks. Next to State Financial Corporation, State Industrial Development Corporations, so district industries centers. So these are all the these are institutions which provide loans, which provide capital to the organizations. So as per the Industrial Development Bank of India, the name itself reflects the functions, which means this bank is established for industrial development. Next, Small Industries Development Bank of India. This is established for encouraging small industries. So they provide long-term loans, short-term loans for small industries. Regional rural banks. So these are established for rural development. Next, State Financial Corporation. So this is also meant for providing financial assistance for long term. Next one, State Industrial Development Corporation. This is established for industrial development. So by name itself reflects the functions of the organization. So let us go through the material and get the results. Government schemes for financial support. So one is venture capital assistance scheme. Second one is Stand Up India for financial SC/ST women entrepreneurs. Third one is Dairy Entrepreneurship Development Scheme. Pradhan Mantri Mudra Yojana. So these are all the government schemes which are provided for the new startups and for the basis of weaker sessions, alage for the benefit of the agricultural and farmers, etc. Next one is, so these are the advantages and disadvantages of owned capital. Next, agricultural risk and insurance. So first one is, first we have to see the insurance. Risks are different, price risk, yield risk. So these are all different. First, agricultural. agricultural insurance, pilot scheme on crop insurance, comprehensive crop insurance scheme, next తర్వాత national agricultural insurance scheme, next farm income insurance scheme, next Pradhan Mantri Fasal Bima Yojana. So these are all the insurance schemes for agricultural insurance. So first one is pilot scheme on crop insurance. So this is the insurance, which general insurance are introduced first in 1973 on experimental basis. Next, here the purpose is this was introduced in West Bengal, Tamil Nadu, Andhra Pradesh. Next, if the actual average yield of the crop in the next, there is an information from the education section. Let us note down. If the actual average yield of the crop is selected area for less than the guaranteed yield of the crop, the indemnity would become payable to all the farmer borrowers. This is the object. Suppose if the actual average yield of crop is less than the guaranteed yield of crop. So there is a guaranteed yield and actual yield, average actual yield. So if there is any difference, so negative difference, so that is to be indemnified to the farmer borrowers. Next, comprehensive crop insurance scheme. So this is introduced in the year 7th plan, that is in 1985. 1985. Next, crop insurance covers from crop loans only. Crop loans ద్వారా ఇస్తూ ఉంటారు. నెక్స్ట్ దీని బెనిఫిట్ ఏంటంటే the identification was on an area basis with the Tahsil Taluka being kept as unit. If there was a shortfall in average actual yield, insured crop as a result of crop failure, if it is below 50%, each of the insured farmer growing that crop in the defined area was eligible for indemnity. So here the area is divided into tahsils or taluka, mandals, like that. So the shortfall of the average yield by acre by crop failure, due to crop failure, if it is less than 50%, if it is less than 50%, then they are eligible for insurance. They are eligible for insurance. So which means they paid insurance. Next, the next one is National Agriculture Insurance Scheme. It was introduced in the year 1999 to 2000 for Rabi season, replaced the comprehensive crop insurance scheme, whatever explained earlier. Instead of that, so it is another scheme is also introduced. Next, under the Ministry of Agriculture. So the object of this scheme is to provide insurance coverage and the financial support to the farmers. Next, to encourage the farmers to adopt progressive farming practices, high value inputs and higher technology in agriculture, and to help stabilize the farmers' incomes, particularly in disaster years. So these are the objectives of agriculture, National Agricultural Insurance Scheme. Next, Farm Income Insurance Scheme. Farm Income Insurance Scheme. So the scheme was conceived to provide income protection to the farmers by integration of mechanism of insurance production as well as market risk. So this is the integration of mechanism of insuring products as well as market risk. So insured products, market risk, both are to be considered. So the farmer's income would be protected by ensuring a minimum guarantee income. Minimum guarantee is to be given under this scheme. Next, indemnity value is guaranteed income minus actual income. Guaranteed income minus actual income. That is to be calculated in the following way. Next, Pradhan Mantri Fasal Bima Yojana. This is started in the year 2016. So the scheme covers all food grains, oil seeds, and annual commercial horticulture crops. Under the scheme, the premium rate is a maximum of 2% for Kharif, 1.5% for Rabi, and 5% for annual commercial and horticulture crops. So the results is what we get. The area approach is used for calculation of widespread calamity. Payment of 25% of the sum insured is provided if there are mid-season adversities. So 25% will be given when there is mid-season adversities. The adoption of remote seasoning technology and drones in yield estimation are silent feature of this insurance scheme. So for estimating the things, they used drones and other technology is also used. Smartphone apps are used for accurate and fast transmission of crop cutting experiments. So these are all used for the agricultural finance, agricultural insurance. So there are certain the risk management is the general topic which you have to read. Next, risks also generally comes under management. So risks are different. One is operational risks. Next, risks maybe sorry. Agricultural risk, components of risk. So these are not important to you. The types of risks. Good. Product price risk. Next, yield risk. Next, the price, product price and yield risk. So these are the risks, which is to be calculated according to the formula. So these are the risks which let us go through the material and get the next one is games theory. This will be explained in operation research tomorrow. Next, so we are completing 2 blocks. Next one, first block is managerial economics. So particularly price determination, perfect competition. Perfect competition means there are so many sellers and there are so many buyers. So in perfect competition, the price is determined by the demand and supply. Demand and supply. So demand means desire and able to purchase. Suppose if a person having desire to purchase, suppose if a person running to the market by seeing a television. So if a person having a desire to purchase television, so that is not the demand of the television. Whenever the person purchase it, then it becomes the demand. So that is there is a relation between demand and price in reverse way. Suppose if all conditions are same, if price decreases, demand will increases. If price increases, demand will decrease. So that's why the demand curve is slopes from left to down, right downwards. Next, whereas supply means supply curve is from left to from right to left downwards. Suppose in case of perfect competition, we ascertain price value, price determination by considering this supply, demand and supply curve. If two curves, that is the demand curve and supply curve, intersects at one point, then the price is determined. Then the price is determined. That is in perfect competition. Next one is that is there are law of demand. Next law of demand. Law of demand means sorry. Law of demand. Law of demand. Sorry. Demand schedule. When price is 7, demand is 10. When price falls from 7 to 6, demand increases. When price falls, demand will increase. So if it falls to 5, then demand is 30 units. If it falls to from 5 to 4, demand is 40, 30 to 40. When price falls, demand will increase. Whereas in case of supply, when price is increases, demand is also supply is also increased for want of getting more and more profits. Price is 1, quantity supplied is 10. If price is 2, quantity supplied is 20. If price is 3, the quantity supplied is 30. So supply, the relation between price and supply goes in same direction, whereas in case of price and demand, it flows in different direction. So that is the function of demand and function of supply. Next. Next, there are different marginal cost, average cost, cost plus pricing. So these are all the other topics which may not covered. I think this session is short session, so I covered most of the things. Students, you can go through the material and read well, and all the best for the coming examinations.
Sir,
Yes, sir.
so our time is already 1 o'clock.
Yes, sir.
So the session is going to close, sir. Is it okay?
Yes, sir.
Good afternoon to all. Today's session, I think sir have explained in briefly. If any further clarification, just go through our material, and you can contact with nearby study centers and approach your counselors. They will clarify your doubts. Today, our session is going to conclude. Now I am concluding the session. Thank you very much, sir, for your valuable time and sparing the 2 hours of your valuable time for our students. Thank you very much, sir.
Thank you, sir.
Tomorrow by 11 o'clock again, sir topic, next paper, sir will continue. After that, Monday again we have the class.
Okay, sir.
Okay, sir. Thank you, sir.
Thank you, sir.
Good afternoon, sir.
Good afternoon.
Sir, I have a question, sir.
So
my name is Amir Sohail, and I am from West Bengal, and my regional study center Kolkata.
Okay.
So I admitted January 2023, but I cannot able to form fill up for examinations, semester examinations.
No, there is semester exam. You have examination in the month of December session. You have to pay examination fee in the month of October or September. University will give the link, online link. You have to pay the examination fee in the month of September or October. So you will have exams in the month of December.
So, sir, my question is that how can I apply for the semester examination form fill up?
That's what I am telling. The examination application form link will be appeared in the month of September and October in the IGNOU website. the same information will be informed by our regional centers. So your regional center will inform to you. Meanwhile, you can check IGNOU website regularly in the month of September and October. So online examination application form will be there in the IGNOU main website. So you can click on that and pay the exam fee through online only.
But sir, previous time I tried to apply for semester examination, but there was no option for PGDAB.
Exam for you. You have exam year-end exam only. You have joined the January session. Your examinations will be in the month of December, not in the June.
Okay, sir. Sir, one more question, sir. How can I get the recorded class?
Recorded class, we will give you the YouTube links to all. After completion of 8 papers, we will send all the YouTube links to all.
Okay, sir. Thank you. Thank you so much, sir.
Okay, right.